In this video, I'm going to walk you guys through everything that you need to know as a first-time credit card user.
My first credit card. Wow, the numbers are all bumpy.
We'll start with the basics of what a credit card actually is and how this is different from a debit card. And then we're going to get into how interest works, what minimum payments actually mean, and how missing a payment can actually affect your credit score. But more importantly, I'm going to be showing you exactly how to use your credit card responsibly to potentially earn rewards, build credit, and stay out of debt. So whether you're a student, a young adult, or possibly somebody who's opening their first credit account later in life, this is the video for you. First, I just have to quickly mention that I am not a financial advisor and this isn't any kind of personalized financial advice. Let's dive in. So let's start out with the basics. What is a credit card? A credit card is a revolving line of credit that a bank or a lender gives you. And that means you can borrow money up to a set limit, spend it, pay it back, and then repeat the whole process over again. And then you can repeat this cycle as long as you're following all of the rules, like making your payments on time. Your credit card balance is going to be the amount of money that you owe on your credit card at any given point in time. This can include any purchases or potentially cash advances that you made, in addition to interest and fees that you may have not paid off yet. You'll also hear about something called the credit limit, and that's going to be the maximum amount of money that you can borrow at a given time. If you go over this credit limit, you might face declined purchases, fees, and potentially other headaches too. Moving on now, some people will start out with a debit card before getting into the world of credit cards, so I want to now explain the key differences between these two. With a debit card, you're spending your own money directly from your bank account. But with a credit card, you're actually borrowing that money, and then if you don't pay it back by the due date, you pay interest on it. So now let's break down how interest actually works with credit cards. Interest is going to be the extra money that you earn or that you have to pay when you borrow or lend money. The interest rate on a credit card is often referred to as the APR, which stands for annual percentage rate. And this is the interest rate that you'll be charged if you don't pay off your full credit card balance by the due date. Credit card interest rates are known to be extremely high, and that's because the debt isn't secured or backed by anything. Other types of loans like auto loans and mortgages have much lower interest rates, but if you don't pay back those loans, they can repossess that car, house, whatever it might be. Let's move on now to why people actually use credit cards. But first, do me a quick favor and subscribe if you've gotten any value out of this so far. So you've probably heard a ton of different reasons as to why people use credit cards, ranging from purchase protection to building credit and more. While it's nearly impossible to cover all of the potential benefits of credit cards, here's the most common ones. First and foremost, using credit cards and financial accounts responsibly has the benefit of allowing you to build your credit history and credit score. Your credit score affects whether or not you can get approved for loans on things like cars and possibly even a house, but it's also going to have an impact on your car insurance rate potentially, and maybe even whether or not you get approved for an apartment. So using credit responsibly and building good credit will actually have numerous benefits across your life that you probably didn't even think of. The second big benefit, and my personal favorite here, is the fraud protection associated with most credit cards. Remember how we talked about credit versus debit earlier on? Well, when you run a debit transaction, it's going to come out of your bank account immediately, and unfortunately the same thing is true with most fraudulent transactions as well. So that means your money is on the hook while the bank investigates the fraud. Now, if that happened to be a credit card with a fraudulent transaction, that is generally their money on the line, and you might not be responsible for anything at all. When you report the fraud, the card issuer will usually investigate and often remove the charges so your personal money isn't at immediate risk. This actually happened to me with my Discover card years ago, and I'll put a card in the corner for that full video on my deep dive review after using this credit card for 10 years. So basically, with a credit card, you're typically more protected. And that's exactly why a lot of people will only use credit cards for online shopping, travel purchases, and other types of purchasing where there is a higher risk of fraudulent transactions. Finally, the last big reason as to why people use credit cards is the potential to earn cash back and other rewards. A lot of credit cards give you perks like 1 to 2% cash back on purchases, airline miles, points, and more. But you need to be careful here because these rewards are directly linked to your spending, and that means that the more you spend, the more you earn. Overall, if credit cards are used in the right manner, they can benefit your life in numerous ways. But on the flip side, if you get sucked into the rewards and treat your credit card like cash in the bank and spend a ton of money, credit cards can be a nightmare too. Now, let's talk about getting your very first credit card, because when you're just starting out, some types of credit cards are going to be a lot better options than others. There are a few different types of beginner-friendly credit cards that you might want to consider, the first being student credit cards. Most of these are designed for college students who have little to no credit history. They usually have low limits, low to no annual fees, and many of them even offer rewards too. Next, secured credit cards are also a great option, especially if you're having trouble getting approved. For this type of credit account, you typically pay a deposit when you open the card. Then you are generally extended a line of credit that matches your deposit dollar for dollar. And if you don't pay off your credit card balance, the card issuer can usually claim your deposit, which is what makes this a secured line of credit. Secured credit cards are often a safe way to build credit without any risk for the bank, but you do usually need a few $100s saved up to get approved. We're now going to talk about how to use credit cards strategically, because this is what a lot of beginners struggle with in particular. But real quick, guys, do me a favor and hit that subscribe button, as we're really trying to grow the channel this year. Rule number 1, and the biggest rule that I follow personally, is to pay off your credit card balance in full each and every month. If you only make the minimum payment, interest starts building fast. Here's the thing, by paying off your credit card balance in full every single month, you can avoid paying interest entirely. And that means you can potentially capture all of the rewards of credit cards, like the cash back potential and maybe even fraud protection and more, without the heavy cost of interest. The next strategy comes down to your credit limit and how much of it that you're actually using. A good rule of thumb is to keep your overall utilization under 30% of your credit limit. So if your limit is $1,000, try not to spend more than $300 before paying it back. This is to show lenders that you're responsible with your money and your spending, and it can help you to build your credit score. And as an added benefit, it can help you to avoid a runaway credit card balance too. Another tip here is to set up auto pay for your credit accounts and other bill accounts. This is one of the easiest ways to avoid late fees and missed payments, because with all of the different things that we need to remember these days, making your payments shouldn't be one of them. And finally, be sure to check your statements regularly, whether this means looking at them in the mail, digitally, or just checking your transactions in the mobile app. This is important not only to catch fraud, but to also keep track of your own spending, because it's a bit too easy to just swipe and forget. Using your credit card responsibly isn't complicated. It's just about establishing the right habits and then being consistent with them. So now that we've covered what to do, it's equally, if not more important, to cover the pitfalls that you need to avoid as a beginner. First of all, avoid making only the minimum payment. While the minimum payment does keep your account in good standing, in most cases it's going to barely chip away at the balance. Meanwhile, the interest just keeps piling up, so making the minimum payment is really like treading water, and you're just not getting anywhere. Second, you need to avoid making late payments, or worse, missing payments at all costs. Late payments usually mean fees, but even worse, if you're more than 30 days late, this can mean a hit to your credit score. Even one missed payment like that can stay on your credit report for years, so be sure to use reminders or use autopay to stay on track. And if you do end up missing a payment, make sure you make this payment as quickly as possible and call the credit card company. Finally, don't open a bunch of credit cards all at once. You need to be strategic with each one of these accounts that you open, as every single one of those inquiries usually impacts your credit score. The last thing I want to cover is how credit cards actually impact your credit score. There's a few different factors that make up your credit score, and credit cards impact most of them. The first is payment history, which makes up about 35% of your credit score. Every single time you pay a bill on time, you are building a positive positive record. But just one late or missed payment has the potential to damage your credit score for years, and that is why on-time payments are so crucial for your credit score. The next key factor is going to be credit utilization, which is going to make up about 30% of the credit score. Once again, keeping this below 30% shows that you are responsible and not relying too much on credit. Then there's the length of your credit history, which makes up about 15% of the score, and that's going to be how long you've had your various accounts open for. Generally speaking, the longer that your accounts stay in good standing, the better that it is for your score. After that, new credit inquiries make up about 10%, so that's why opening up a bunch of accounts at once can hurt your score. And finally, your credit mix makes up the roughly final 10% of your score. Having a variety of account types like credit cards and loans can be a positive for your score, but that's only true when you're responsible with them. But I want to leave you guys here with this question. Do you actually know what your credit score is? If you do, you can pat yourself on the back because this puts you ahead of the curve, especially if you're a young person. And if you don't know what your credit score is, do me a favor, download the NerdWallet app. It has a 4.8 star rating in the App Store. You're going to be able to see what your credit score is and be able to monitor it over time too. So click the link down below to download the NerdWallet app today, and while you're down there, don't forget to subscribe. If you're ready to look at some credit card options, check out our next video here on the best rewards credit cards, according to the experts here at NerdWallet. We'll see you next time.